A very good morning, everyone, and welcome to your weekly market outlook with me, Geoffrey Gishanga, educator and market analyst, Scope Markets Kenya. So I hope you all had a very amazing weekend. And as we get to start off this week, we get to start off with our outlook. So this week's outlook briefing covers key central bank policy updates, U.S. economic indicators, major earnings announcements, and global monetary policy developments. So last week was more of a central bank week. We had quite a number of central banks releasing their monetary policy statements, from the Federal Reserve to the Bank of Canada to the Bank of England, we had the Bank of Japan. So it was quite a very phenomenal and fundamental week because of all these central bank releases. So there was quite a lot of volatility and market reactions across the various currencies. And let's get to see what happened, what are the impacts, and what do we expect for the week as we get to start off the week today. So welcome on board and walk with me. So starting off, we get to look at the Bank of Canada. So the Bank of Canada reduced its policy rate by 25 basis points, bringing it to 2.5% from the previous 2.75%. Something you will notice about these central bank releases for last week, you will realize quite a number of rate cuts, but also you will see quite a number. You'll also see quite a number of central banks maintain their policy rates, but we also saw significant rate cuts by, like now the Bank of Canada. We had the Federal Reserve as well. So you're going to see all that unfold and how it also affected the various currency pairs. So like I've mentioned, the Bank of Canada reduced its policy rate by 25 basis points, bringing it to 2.5% from the previous 2.75%. So what does that show? What does that highlight? So global growth has shown signs of slowing, largely due to sharply higher US tariffs and ongoing trade uncertainties. Remember, Canada was one of the largest hit by US tariffs. Okay, so definitely it has really affected the Canadian economy. Then in the US, in the US, business investment remains strong, but consumer caution and slower job growth are beginning to weigh on the momentum. Then also remember that inflation in the US has risen, with businesses passing on tariff-related costs to consumers, and the euro area growth has weakened as trade pressures intensify. So we are seeing quite a lot of effects of the Trump tariffs, or the US tariffs, on Canada. So bringing quite a bit of slower growth as compared to how it was before these tariffs came through. But then the Bank of Canada is trying its best to maintain the levels of inflation, and also bringing down rates to 2.5%. So the Bank of Canada's decision reflects its intent to support economic activity amid rising global headwinds while keeping inflation expectations anchored. Okay, so that is from the Bank of Canada. Then you also had the major expected Federal Reserve, the FOMC policy decision, which happened last week. So the Fed lowered the policy rate by 25 basis points, setting it to 4.25% from the previous 4.5%. Now let's talk about the rate cut. First of all, the rate cut was quite anticipated. It had been forecasted for quite a while. Now, with the anticipation of having a rate cut, a 25 basis points rate cut, we saw that happen. However, there was a very hawkish tone on inflation, and that is what caused dollar strength amidst people expecting some weakness because of the rate cut. So the rate cut happened, yes, but there was a very hawkish tone on inflation by the Fed Chair Jerome Powell. So that brought about quite some very strong dollar. So some of the key observations we had, some of the key observations we have is that we had economic activity moderated in the first quarter of 2025. Job gains have slowed, unemployment edged higher but remains historically low. Inflation is still elevated, still very high, exceeding the Fed's 2% target. Remember, the Fed has been trying to bring down inflation to 2% for the longest time now, and still hasn't managed to do that successfully yet. And we have risks to both inflation and employment. They still remain high. Remember, inflation is still very high. And employment also, we're seeing record numbers being very high for unemployment as well. So it's something that is a constant, it's something that is a big concern. Okay. So uh, the Fed reaffirmed its commitment to maximum employment and a 2% inflation target. Remember, they have been trying to bring down inflation to 2% for quite a while. So further rate decisions will depend on incoming data with a willingness to adjust policy if risks emerge. So we have the next FOMC meeting in October, sometime in October. So definitely then we will get to see, will they maintain the rates or will they get to cut the rates further? Okay. something to closely to closely observe. Then we have the Bank of England. The Bank of England as well released their policy statement last week. So that's why I started by mentioning that this is quite a central. I mean, last week was quite a central bank week because we had quite a number of central bank releases. So you have the Bank of England released their policy rates, and they maintained their rates at 4%. So two members preferred 25 basis points rate cut to 3.75%. So out of all the members, two preferred a rate cut, then seven maintained to hold the rates at 4%. So they also voted to reduce gilt holdings by 70 billion pounds over 12 months, bringing the balance to 488 billion pounds. So the economic backdrop is that, or the observation. Inflation has fallen from pandemic era highs, but CPI inflation stood at 3.8% in August. And inflation is expected to inflation is expected to rise slightly in September before resuming its decline towards the 2% target. So realize how most central banks are trying to curb inflation or bring down inflation down to the 2% target. The pay growth remains elevated, but is slowing. Then GDP growth remains subdued, consistent with a loosening labor market in the UK. Okay. So the Bank of England is adopting a gradual withdrawal approach, ensuring disinflation continues while preventing renewed price and wage pressures. Okay, so something to closely observe. And from that, you actually saw the British pound weaken. So after these releases, saw the British pound really weaken across all pairs that have the British pound. Then we also, when we had the Fed releasing, when they actually had the Fed releasing the policy rates, there was quite a lot of volatility during that release, because traders, investors globally were highly. I mean, traders, investors, economists globally, they were highly waiting for this release that now sets the pace for the next quarter. Now, as we get into the last quarter of the year, so that sets the pace for this coming quarter, the last quarter of the year. And there's quite a lot of volatility across all the dollar pairs. And considering we saw a very strong dollar, so all pairs USD CHF, USD JPY, USD CAD very bullish. Then pairs like Euro USD, GBP USD, we had very strong drops. Okay, and then now after the Bank of England released their policy statement, so it further weakened the pound. Okay. Then we have the Bank of Japan as well released their policy statement last week. So there was quite a lot of central bank releases last week. So the Bank of Japan maintained its rate at 0.5%. Now the rate of 0.5%, this is the highest that the Bank of Japan has gotten their rates to in the last 17 years. So mostly the BOJ has maintained their rates at negative, then slowly has been going up. So now it's currently they've maintained it at 0.5%. So additionally, it announced the gradual sale of ETFs and J rates in its holdings, aligning with its principles of avoiding market destabilization. Okay, so Japan continues to experience subdued inflation and low growth, prompting an accommodative stance. The asset disposal plan indicates a careful move towards normalizing policy while safeguarding market stability. Okay. Then you had the US unemployment claim. These are weekly unemployment claims. So the initial claims were at 231,000. So that is a drop of 33,000 from the previous weeks, from the previous week. Then the 4-week average was at 240,000. That is a drop of 750. Then the insured unemployment was at 1.92 million. That is a drop of 7,000. Okay. Then you have the insured unemployment rate at 1.3%. So the labor market remains resilient, with claims falling sharply after a temporary spike. So, however, moderation in hiring and job gains suggest a cooling trend consistent with Fed expectations. So the temporary spike happened both during the Fed release and also during the unemployment claims release. Okay. Then coming from that, we now get into the earnings sector. We had various companies releasing their earnings last week. We had FedEx, and our major focus will be on FedEx and Adobe. Okay, so starting off with FedEx. So with FedEx, we have FedEx delivered a strong performance, beating expectations. So the earnings per share are as follows. We have the earnings per share was at $3.83 adjusted versus the expected $3.59. The revenue was at $22.24 billion versus the expected $21.66 billion. So definitely they beat their revenue expectations. Then the net income was at $820 million, up from $790 million year on year. Okay. So again, that is a positive. So what are some of the key factors that cost these results? We had US package volumes rose by 6%, boosting results. FedEx freight segment lagged due to higher wages and lower revenues. Then the 2026 outlook, the revenue growth forecast at 4% to 6% versus 1.2% consensus. The earnings per share expected at $17.2 to $19. Again, that is a forecast, not a surety. That is an expectation. And the midpoint should be at about $18.10. Again, that is a forecast, just an expectation. Okay. Now the strategic note. So FedEx is proceeding with its FedEx Freight spin-off, set to be completed by June 2026. So the removal of the $800 de minimis exception globally has added cost pressures. So, but FedEx responded with modest shipping fee increases. Okay, so FedEx does shipping globally. Okay, so FedEx does the shipping globally. All right. Then you have Adobe. So we look at the earnings for Adobe. So Adobe reported strong quarterly results. The earnings per share were as follows. So we had $5.31 adjusted versus the expected $5.18. Then the revenue was at $5.99 billion versus the expected $5.91 billion. So the revenue was 5.99, the expected was 5.91. Okay. Then the year-on-year growth, the revenue was up 11% from $5.41 billion. The net income was at $1.77 billion versus the $1.68 billion year-on-year. Then the guidance we're looking at, so Q4 earnings per share, we are looking at $5.35 to $5.40. Then Q4 revenue, $6.08 billion to $6.13 billion. So those are expectations. Okay. Then digital media ARR expected to rise 11.3%. Okay. Then something to note, Adobe emphasized its AI integration with AI influenced ARR surpassing $5 billion. So that is up from $3.5 billion in 2024. So despite strong fundamentals, Adobe stock is down 21% year to date, underperforming the Nasdaq, which has rose a positive of 14%. Okay, so something to closely observe on the Adobe stock. Then you have a global outlook and risks. So you've seen central banks, the Fed, the Bank of Canada, are easing policy cautiously amid slowing growth and inflation uncertainty. Then the Bank of England remains vigilant against medium-term inflationary risks while growth stagnates. Okay, so we have that. Then the Bank of Japan remains ultra loose policy. The Bank of Japan maintains a loose policy, balancing inflation stability with asset disposal strategies. Then from earnings, we've talked about FedEx and Adobe. They highlight resilience in logistics and tech. They highlight resilience in logistics and tech, though global trade headwinds and AI-driven sector shifts remained dominant themes. Okay, so remember, tariffs have really affected most of these key companies, and definitely it has a toll on their revenues and their earnings. Okay, so with that, now let's look at what we are expecting for the week as we start off this week. So we'll be having the euro and the pound flash PMIs, the services PMIs. Then that is tomorrow on Tuesday. Then we will also be expecting the Fed Chair Jerome Powell to be speaking again on Tuesday. That is tomorrow in the evening. Then we will be having the AUD CPI expected year on year. Then on Thursday, we will be expecting the Swiss National Bank releasing their monetary policy statement for the Swiss franc. Then our weekly unemployment claims for the dollar and the GDP. And lastly, ending the week, we have the Canadian GDP and the USD core PCE price index month on month, that will be ending the week on Friday. Okay, so this week again, you have quite a number of high impact news to be watching out for. Highlight of the week, we'll be looking at the euro, the pound, the dollar, the Swiss franc as well, and the Australian dollar because of the CPI. Definitely telling us how inflation is looking at in the Australian region and what to expect for the Australian dollar and all pairs that are paired to the AUD. Okay, so so with that, guys, I'd like to come to the end of this outlook. I'd like to wish you all a very fruitful and productive week ahead as you get to start off the week. It's a very bright Monday morning, very energetic. So let's get it, everyone. Have a very productive and fruitful week ahead, and see you on the next one.